Welcome to the Deep Dive. Today, we're cracking open what many call the absolute Bible for traders, maybe even investors too, Reminiscences of a Stock Operator. Now, you might not know the author, Edwin Lefèvre, right off, but the character he writes about, Jesse Livermore. Though Lefèvre calls him Larry Livingston in the book. It was written way back in 1923, but honestly, the lessons feel like they could have been written yesterday.
They really are timeless. It's this amazing story of how Livermore, or Livingston, made fortunes, lost them, and made them back again. And what we want to do today, our mission really, is to dig into why it's still so relevant.
Yeah, like what are those core insights, the psychology, the strategy,
Yeah.
the stuff Wall Street still fundamentally runs on?
Exactly. We're aiming to pull out those enduring mechanisms, the stuff about human behavior under financial pressure that just doesn't change.
Okay, let's unpack this journey of a financial titan. It starts, surprisingly, not with big trades, but with Livermore as a teenager.
Yeah, just a kid.
Just a kid, working as a, quote, boy in a brokerage. You know, literally writing stock prices on a big chalkboard as the ticker tape came in. He wasn't even trading.
Just watching the numbers flow?
Right, but just staring at that tape all day, every day.
Hmm.
That's where he had his first big aha moment. He started to notice things.
Patterns.
Patterns, exactly. He realized the market wasn't just random chaos. Stocks seemed to behave in certain ways, before making a big move, up or down. So he started keeping this little notebook.
His secret code book.
Yeah, basically. Tracking these little ticks and moves, trying to, crack the code of the market's rhythm.
And what's really fascinating here, I think, is how he learned. It wasn't theory from books or, lectures from professors. It was pure observation, learning the market's actual behavior directly from the tape.
Totally empirical. And he didn't wait long to test his ideas. He started betting in these places called bucket shops.
Ah, the bucket shops. Not exactly the NYSE.
Not at all. They were basically gambling dens, right? You weren't actually buying stock. You were just placing a bet on whether the price would go up or down.
Highly unregulated.
Oh, completely. But Livermore, using his notebook and his observations, was incredibly good at it. So good and so aggressive with his bets for his age that they nicknamed him the Boy Plunger.
Plunging right in.
He won so consistently that eventually the bucket shops just couldn't afford him anymore. They realized this kid knew something. He actually got banned from, all of them.
Which is kind of a mark of success in that world, I guess. But it forced his hand, right? If he wanted to keep trading, he had to go to the big leagues.
Exactly. Off to Wall Street. He arrives, pockets full of cash from the bucket shop, super confident in his system. He probably thought, this is going to be easy.
Famous last words in trading.
Totally. Because his system just imploded. It didn't work on the New York Stock Exchange. In fact, it basically guaranteed he'd lose money.
And the reasons were pretty fundamental differences in the environment, weren't they?
Yeah, a couple of big things. First, in the bucket shops, the quotes were often slightly delayed. His whole system was based on anticipating tiny quip moves based on that slight delay. Wall Street. Information was instant, real time.
No edge there anymore.
Gone. And the other huge thing was scale. His trades were suddenly big enough to actually move the market he was trading in.
Right. He wasn't betting against the house anymore. He was interacting with real supply and demand.
Exactly. So if he tried to buy, say, 5,000 shares of something, his own buying pressure would push the price up while he was still buying. Traders call it slippage. He was fighting against his own actions.
Which completely wrecked his old strategy of scalping tiny profits. The cost of getting in and out was suddenly way higher.
And the result? He lost everything, went broke, had to borrow money to get back in. And this happened, multiple times.
It's brutal, but this brings up a really key point in his story, and maybe in all trading. Why is failure so central to his legend? He was obviously brilliant.
I think the book really hammers this home. Each time he failed, each time he went broke, he didn't blame the market or bad luck or, someone else. He analyzed himself. What did I do wrong?
That's the hard part, taking responsibility.
It is. He had to ditch the ego, ditch the attachment to his old ways. Failure became his greatest teacher. It forced him to evolve from that quick scalper into a much more disciplined, strategic thinker.
Focusing less on the quick buck and more on the bigger picture, the psychology driving things.
Right. And that painful process led him to develop these, timeless rules of speculation. This is really the core of the book, a part people quote all the time.
Let's get into them. Rule number 1 is maybe the most foundational. The trend is your friend. Sounds simple, maybe even cliche.
Yeah, but what does it really mean in practice?
Yeah.
It's about identifying what Livermore called the line of least resistance.
Right. It's about finding the path the market wants to take right now. Where is the momentum? Where is supply and demand pushing things without a major fight?
So don't fight the tape, basically. Don't try to be a hero and catch a falling knife just because you think a stock is cheap.
Or short a runaway bull market because you think it's overvalued. Your opinion doesn't matter as much as the market's current direction. You wait for the market to show its hand, confirm the trend, and then you align yourself with it.
Okay, that makes sense. Which leads straight into rule number 2, and this is the one everyone struggles with. Cut your losses, let your winners ride.
Ah, yes. Easy to say, incredibly hard to do. Why is that?
It hits right at our core emotions, doesn't it? Hope and fear. We hope a losing trade will turn around, so we hold on, maybe even average down, digging a deeper hole.
Praying to get back to even.
Exactly. And then with winners, we get fearful. Fearful the profit will disappear, so we snatch a small gain way too early, missing the big move.
Livermore was apparently ruthless about this. A small loss. Cut it immediately. No questions asked. It's just the cost of doing business, but a winning position.
That's where the patience came in. He'd let it run. And not just run, he'd often add to it. Pyramiding, they call it.
Yeah.
If the trade was proving him right, he'd increase his bet, using the profits to build a larger position.
Using the market's confirmation to increase exposure. Smart, but requires real nerve.
Definitely. But wait, how does cutting losses quickly fit with Rule 4, which we'll get to, about needing patience for the big swing? Seems contradictory.
Good question. It's about when you apply the action. Livermore often used what he called a testing trade, a small initial position.
Okay.
If that small test immediately went against him, bam, cut the loss. Quick action because the market instantly said you're wrong. But if the test worked, if it moved in his favor, then the patience kicked in. He'd wait, let the trend develop, maybe add more, and hold on for that bigger move. The quickness was for error correction. The patience was for confirmed success.
Ah, okay, that clarifies it. Which brings us to Rule 3. The market is never wrong, opinions are.
This is pure ego management. You can have the best analysis, the most detailed charts, whatever, but if the price action, the tape, is going against you.
You're wrong, period.
Exactly. The market is the ultimate arbiter. You have to kill your darlings, ditch your pet theory, and listen to what the price is actually doing.
That had to be a tough lesson, especially after his early success. Leads into Rule 4. The big money is in the big swing.
Right. This was his major evolution from the boy plunger days. He realized that trying to grab tiny little profits all day long, scalping was exhausting, and on Wall Street, often counterproductive because of costs and slippage.
So where was the real money made?
In correctly identifying and riding the major market trends, the big bull markets, the big bear markets, moves that could last for months, sometimes even years.
And that requires immense patience.
Immense patience. You have to sit through the noise, the minor corrections, the volatility that scares out the weaker hands. You wait for the real signal, the major shift, and then you have the discipline to hold on.
Makes sense. And the last big rule, Rule 5, learned the hard way. Beware of tips and inside information.
Yeah, he apparently got burned really badly early in his career by acting on a hot tip someone gave him.
And the lesson there is pretty cynical, but probably true.
Pretty much. If this information is so incredibly valuable, so guaranteed to make a fortune, why is this person telling you? Why aren't they quietly mortgaging their house and betting everything they have?
Good point. Trust your own work.
Trust your analysis of the market's action. The tape, that's the only thing that's verifiable. Everything else is just noise, or worse, potentially manipulation.
Okay, so those are the core principles. Now, here's where it gets really interesting. Connecting these rules to how he became the great bear of Wall Street.
Right, putting the theory into legendary practice.
The first huge example was the panic of 1907. The market had been booming. Lots of optimism, maybe irrational optimism. But Livermore, applying his rules, saw the warning signs. He saw the structure weakening.
The line of least resistance was shifting downwards.
Exactly. And he didn't just jump in shorting everything. He did those testing trades, waited for the market to confirm the breakdown. Then, once it was clear, he went short. Big time. Betting on a collapse.
And he held that position, using that patience from Rule 4, even as others might have panicked or doubted.
Right. When the panic finally hit, his discipline paid off massively. Story goes he made his first $1 million in a single day. That's 1907 money.
Incredible. That cemented his reputation right there, the Great Bear.
And then, arguably his most famous trade, the one that really defines his legend in the book, the crash of 1929.
He did it again, but on an even grander scale.
By then, he was a master of reading the market mood, the psychology. He saw the roaring 20s speculation getting out of hand, the irrational exuberance. He positioned himself heavily short, well before the crash.
And think about the mental fortitude that takes. Rule 3 in action, ignoring the prevailing opinion, the nationwide party, and trusting his read of the tape. Holding short while everyone else is chanting, bye, bye, bye.
The pressure must have been immense. But he waited. He let the market prove him right. When it finally broke in October 1929, he was positioned perfectly. Reports say he made the equivalent of over $1.5 billion in today's money.
It's staggering, and it's important to clarify, as the book implies, he didn't cause the crash. He wasn't some villain manipulating things. He was simply a master interpreter of market forces and mass psychology who positioned himself correctly for what he saw as inevitable.
He read the signs and acted decisively based on his hard-won rules. So when you boil it all down, what's the ultimate takeaway from Reminiscences?
I think it's that the market is fundamentally a game of human emotion. Fear, greed, hope, ego, they drive everything.
Yeah, the charts and the numbers matter, obviously, but Livermore's story constantly points back to the internal battle. The biggest enemy isn't the ticker tape, it's yourself.
Absolutely. Success isn't just about analysis. It's about discipline, controlling those impulses. It's about patience, waiting for the right pitch. It's about learning relentlessly from your mistakes because mistakes are guaranteed.
And understanding how the crowd thinks and behaves. Mass psychology.
Which leads to maybe a final thought for everyone listening. Livermore, through incredible effort and painful lessons, seemed to master the market's movements. But if you look at his life story, which continued long after the period covered in the book, it suggests maybe he never fully mastered himself.
Interesting point.
The technical side, the analysis, maybe that's actually the easier part in the long run. So the question to ask yourself is, which is truly harder for you to control, the unpredictable market or your own internal emotional reactions to it?
Definitely something to chew on. Thanks for joining us for the deep dive.